can discuss the latest BI report. All right, so here you should be, let me share the screen. Yep. So here you should be able to see the platform, but again, if you're not signed up, this is what you will see when you sign up for the platform. Or maybe I should start at the top. This is what you'll see at the Bitcoin Intelligence. We have some charts, valuation models, and the Bitcoin cycle model, and our BI reports, which also you can access here. The last one we published is this Monday. We looked at the rally, the massive rally that we've had. Can I make it larger? Yep. The massive rally that we've had, and whether it has run its course temporarily or it needs a breather. So what we have looked at is, again, like always, a combination of macro and on-chain. First, it's important for us to understand what's happening at the economic layer: inflation, labor market, company earnings. But the other thing is, last week we had this huge call for revisiting the lows. There was a lot of worry, lots of people, JP Morgan CEO Jamie Dimon, and also billionaires like Steve Cohen, Paul Tudor Jones, and Druckenmiller. They were all calling for revisiting the lows. A lot of people were worried about it. So we were looking at the data to make sure, can we find any signs that we are in trouble? And this report basically answers that. And we look at the trade war, we look at the Moody's downgrade, we look at inflation, labor market, and then supply and profit from on-chain data, unrealized gains, the key levels to watch. By the way, we mentioned 110 to be a resistance, and I think today looks like we got right below it before we correct back down, and more. So moving on the macro side, we discussed that we had a historic V recovery. Again, the V-shaped recovery has been a theme of our analysis. We were constantly saying that things might quickly bounce back up, and we mentioned here that it even surpassed our expectations. So that's why we wouldn't be surprised if it takes a step back for a while for the market to kind of a little bit absorb the new flows and then keep going forward. Importantly, we have been discussing this idea that all this grandstanding from Trump, saying that he will never negotiate with China, and the same thing from China saying that we will resist up to the end, all of that proved to be just PR, and they really didn't intend to decouple. The moment the respective economies slowed down, or actually began slowing down, they came up to an agreement. So the big reason the markets rose was the trade war easing, a 90-day pause. And this is what you can see, how the trade progressed between trade war progressed between China and the US. Initially a 10% tariff, then a 20% fentanyl, then 54% retaliatory, then reciprocal tariffs, then retaliation, 104, 145, and then suddenly all of that has gone away and we're back to 30%. And then that 30% includes 20% fentanyl, which is, it is very fixable the way we write it, because China can do a lot more in curbing the exports of precursor chemicals that will be able to transform into harmful drugs. And if they do, supposedly these tariff levels will also go further down. So, and to confirm that, by the way, this is also what we had predicted a few weeks back, saying that don't listen to all that rhetoric. They will come to an agreement pretty soon, and the markets will react very positively to it. But confirming that, Scott Bessent is saying that we don't want to decouple, and we simply want to reach to an agreement and lower our tariffs. This is what they said over the weekend, and completely different than what they have been saying previously. Commensurate with that, odds of recession have gone down significantly, and investors are beginning to reduce bearish positioning, adding more bullish positioning, but on the balance, there is still more bearish. So the rest of it is supposed to be premium, so I won't show everything out of respect to our premium subscribers, but we talk about the general ideas. When you look at inflation, you do see a clear trend that inflation is coming down. And this is, again, going fully against a lot of the calls that tariffs are inflationary. People that say tariffs are inflationary only get half of the story right, because tariffs definitely raise prices, but then what happens is consumers reject it, and economy slows down. That's why you actually don't get a sustained inflation from it. And the Fed has also signaled that they're willing to look past a short-term rise in prices. So a reduction in prices is absolutely expected. Again, we might have some month-to-month fluctuation as the immediate effect of tariffs show up, and that might scare the markets a little bit here and there, but the trend is toward deflation, which is a really good sign for the longer run because it allows the Fed to cut the spending. The other important feature here is Moody's downgrade, right? So again, last week people were very worried about that, but the problem is Moody's basically, it's the third time the U.S. credit is downgraded, and the effect was basically experienced the most at the first time. And then after the first time with S&P, everyone has updated their contracts, so subsequent downgrades really doesn't have material effect on investors' ability to invest. But it does. But we mentioned it does have a major symbolic effect. So psychological effect might actually turn out to be important. But mechanically, everyone that could buy treasuries before, they could also buy now. But interestingly, we do see that the bond market is now being very worried. And then when you look at, so we talk about inflation being low, consumer is strong, looking for signs of recession. Consumer is very strong. They don't really show a major setback. Labor market is doing well so far, knowing that labor data is not, is a little bit lagging. So you have to be careful with that. But it's still no sign of major downturns. Overall, seems like the economy is not on a recessionary path, especially because they started negotiation and made significant progress, 90-day pause, and also a pause on the world. And it's very likely that over the next 3 months, 2.5 months, they will be able to announce many more deals. And when that happens, just to wrap this macro part up, we have a lot of positive things happening over the summer and towards the end of the summer. First, the tax cut bill is progressing. There is a lot of negotiation back and forth, but it will most likely pass, and it will most likely expand deficit. More deficit means more stimulus and more money going around, and hard assets like Bitcoin will absorb that the most. The other factor is more deregulation and more trade deals. Both of them will be happening over the summer. All will be just adding more positive fuel. In the short run, the only thing that could worry me is some short-term effect because of the tariff uncertainty that we've seen in the first half of the year. So we still haven't seen the full effect yet. So we might have like this little mini tsunami that's coming towards us. Once it arrives, and once we see a lot of problems in shortages in inventory and shipping issues, and maybe short-term rises in different pockets, once that is observed, then we can confidently say that the trade war issues are fully over. and then we can move on to other parts of the analysis. So barring a little bit of short-term uncertainty, I think the major moves for Bitcoin and markets will come in the second half of the year, and it's going to be a really major move. All right, so I'll stop there and move on to Z's analysis. What do you got for us?
Well, just going back to what you were saying about the macro, the bottom line for Bitcoin, from my perspective, is it is the correlation between the macro factors and what is happening in Bitcoin in terms of price action is at its max. Like Bitcoin spot market showing a lot of uh, strength, like as we spoke about the last 2 weeks. Spot market is strong, even though perpetual and options was a little bit lagging, futures was lagging. They're catching up. So from Bitcoin perspective, Bitcoin investors perspective, everything is ready to just go even beyond 110 or 109. But still, the fear over what's going to happen in macro. I'm not really macro savvy, but the 10-year bond yield was skyrocketing not only in US, Japan as well. I am really keen to see if Bitcoin is going to truly act as a hard asset when the uncertainty globally is just going up. Is it going to be Bitcoin who is playing the role that gold is playing now? That's what I'm really keen to see. But let's put aside macro and literally look at the on-chain data, futures data, and see how the investors are positioning themselves. If I want to be go to the point you made about 110,000 price target that we mentioned last week or in our report on Sunday, where it came from. I just want to get to that. This chart, it was using that BI report. We're talking about the red line here is the cost basis of the short-term holder, or simply put, the investors that are investing in Bitcoin recently, in last 6 months. They are the one that are closer to the demand side. Whatever they do is representing the demand side way better than the Mac or broad market investors' behavior. If you look at the cost basis, it was 94. Above the cost basis of these investors means market is bullish. Market is pricing Bitcoin above the cost basis of recent investors. So new investor will be incentivized to jump in and buy Bitcoin. And when we talked about 110, we were talking about around one standard deviation above the cost basis of the recent investors. And 103 was very significant, and we were hovering around 103 for last couple of days or even a week ago. It was because it was half a standard deviation above the cost basis of these short term. All these standard deviation above the cost basis of the short-term holders is going to help us to spot the statistically important price levels that usually take some time to go through. But right now, this is daily close yesterday. By end of today, we were around 109, 109.8, which is close to 100,011, which is one standard deviation above the cost basis. And if you go back, you could see every time we broke the half a standard deviation, almost 90%, 95% of the time, we had enough momentum to reach to one standard deviation. And we have to see if we get that breakout to 1.5 standard deviation above that, which is around 120, 118, 120,000. That's where the 120,000 target is coming from. If you are reading a on-chain piece by other on-chain analysts, this is one standard deviation above the cost basis of the recent investors. If if you look at the other metrics, which is showing the deviation from this cost basis, and also the orange bar on the background showing the funding rate, the levels that we are at is very similar to what we were at November 2024. Like I explained, we broke above the cost basis of the short-term holder. We are reaching to half a standard deviation of above the cost basis, and we're ready to see the next move. Every time we got to this level, we had a high probability to reach to the one standard deviation or 1.5 standard deviation. It's really interesting to see if this time we get to see that jump again. If we do, we are literally repeating what we saw in 2016. If I go back all the way to 2016, you will see in 2016 we had one, two, three, almost four wave of breaking and correction and going above one standard deviation. And here in this cycle, we didn't have that quick jump into one standard deviation and followed by a correction. We had a slower, but in terms of number of waves of rallying to one standard deviation, we had one here, two, three, four, five. So when you structurally look at the market in general, we are repeating a very similar behavior to 2016, but at a slower rate versus the 2021 where the COVID after COVID correction, the money they printed, because we had a long-term kind of like move towards the above the cost basis of the short-term holders. But 2016 we had very similar movement. We had short-term the price getting above the short-term holders and multiple waves of rallies. So let's see what happens. So far we were really close to 2016. If we really head towards 118 or 125, we repeated 2016 spot-driven market, which is really interesting. Next thing I want to point out is, like I said, if you look at the funding rate, it is not just reaching to the level we had back in October, before the election. That is not a big concern. If we see the price rallying above the 103, this funding rate will catch up. But if we had a correction and a macro factor just scare the market, this funding rate might not reach the level that we saw before in October 2024, and that would be a concern. I mean, if you go back and zoom back and look at the funding rate across all assets, the major assets in cryptocurrency market, here I just filtered out the funding rates when they are above 15% APR, like yearly interest is around 15%. This is significant when it goes above 15% yearly. You could see back in October to December 2024, almost all assets were experiencing a very high funding rate. But currently, we are not seeing that hype in funding rate. Like I said, it might take some time, but we have not reached to that level. That's why in last 2 or 3 weeks, we keep saying the perpetual market specifically and broadly, the futures market needs some time to catch up. And the other thing is, first time we reached above 100,000, it was like reaching to a new all-time high for first time. We were not seeing much shorting happening because market was surprised by breaking above 75,000, and we didn't have some time. The perpetual investors had not enough time to start position themselves and short the market. But right now, reaching above 103 or 105 for second time, you'll see there is a significant amount of positions that they could be like wash trading the market. I'm not saying every position you see above 100,000 is literally betting on price going down, but there is a little bit pressure expected this time for the price to go above 108, 109, and we might as well just break through all of this. Look at here. A lot of people are betting on price just going down and not making above 73,000, but all of them were proven wrong. But is it significant compared to the December 2024? We have this chunk of positions in the perpetual market betting on price weakness in near future. But let's see, maybe they are proven wrong. So far we established that why 1010 was a target and why is it significant. We want to go through the on-chain matrix and see what's happening behind the scene. Like we mentioned in the report, the 93 almost to 96 was a really concentrated supply range. What do we mean supply range? We're talking about the number of coins that had a cost basis between 93 and 101 or 102, 103,000. These coins are the coins that moved previously in the December to January 2025. These coins were top buyers. If you look at them, they held through the market correction, or some might say crash to 74,000. That is really significant because usually that like 15-20% correction from all-time high would spook these top buyers, and it was very well expected that they start to sell and deepen the market crash or correction. But they held strongly, and this is really significant. And breaking above this zone is significant from other perspective because they could sell at break even. They might have held their coin all the way through the correction, but they had the chance to start to spend a little bit. And as you can see, from 98 to 101, if I zoom in, these bars got a little bit lost the intensity. That means they start to spend. That means they start to sell a little bit and cash out at break even or very narrow, small profit margin. But it's still the majority held, and it is really significant. If you look at the break down this zone to short-term holder and long-term holder, you could see when we reach to 95,000, the price 95,000, there is a long-term holder attributed supply getting like shown in this metric. That means whoever bought here now is a long-term holder because they held more than 6 months. And that's why 94 or 93 to 100,000 is really significant resistance. If you manage to stay above this resistance or zone for a longer time, the chance that this zone become a support for midterm or hopefully in long term is really high. But we have not getting away from this much. Like if you go back in November 2024, we got above this by, I don't know, factor of 50%. 50% above that was the all-time high. We need to go above this price way much higher to be certain we are not going to go back to this range for any time soon. And that is why in the report we say now or never. We need like at least one standard deviation above the cost basis of short-term holder, which is 118, before saying, hey, we significantly broke above the last all-time high. We are in price discovery, and we should expect a, I don't know, rally to higher prices. But before breaking above 110, I mean, in a meaningful way, we should be concerned about this zone. So far, it acted very nice, especially holding through this correction. And I would say, I mean, if I was about to speculate, if you go back and look at the buying pressure by institutions, especially ETFs, you could see some confluence. That patient buyers that we have talked about in last couple of months in our newsletter seems like are showing their effect in this cycle. They are buying at a discounted price. They're not in rush to buy at the top, but when they buy, they hold. That is the new player in the market, and you could see again and again, like 2024 and now in 2025, they are holding their coins. I mean, at very interesting time. Like we could see a lot of sell-off by this supply zone, but they didn't. And we saw an accumulation actually at 74 to 80,000. That was really interesting.
But so short-term holders seem to have used some of the opportunity to go to cash out at break even, right?
Exactly. They saw a little bit. They sold a little bit. You could see a little bit. They got like the intensity just dropped a little bit. Part of it could be some of them are becoming long-term holder. That's to answer that question, because when you see the short-term holder are getting out of the market or their share from the market is reducing, that doesn't mean they necessarily sold. It could be actually they are holding long enough to become a long-term holder. So they're maturing. That's why short-term holder share is reducing. To answer that question, we have to look at how much profit was realized by short-term holder and long-term holder. That brings us to the next chart. If we look at the amount of profit being realized at 1010, 109, 106, and compare it to previous all-time high or around all-time high periods, we can see right now we saw around 13,000 BTC worth of BTC profit being taken off the table. If you look at the statistical significance of this profit taking, we are almost around half a standard deviation above the norm, half a standard deviation above the normal profit taking in the market, which is pretty significant. If you look back, that is actually the decision point or the inflection point in the market. If we manage to sustain above 1010 and price start to go up, we most likely will see the profit taking will ramp up to 1 standard deviation or above 1 standard deviation. Then we should be concerned. So to answer the question to people, what's going to be the price tomorrow? I would say no one knows what's going to happen. Everything is ready for breaking above 1010 and go 118 and 120 or 125. But no one can predict the macro. And to be honest, from my perspective, macro is a little bit scary because there is a divergence between the yields, long-term bond yields, and the tech companies at a max 7. I mean, I can't understand it. Maybe I need to do like more research and listen to you, Sina, actually, and understand why is that happening. Maybe too much optimism towards the tariffs, and U.S. economy is scary as well. But if we put that aside and say nothing happens and we have a V-shaped recovery, we're going to go to new all-time high in S&P. We are ready to break towards 118 and 125. When that happens, we have to watch the realized profit and loss metrics. And if you're interested to spot the overheated, too much profit going out of the market, or demand exhaustion, this is the metric that you have to look at: realized profit and loss. And specifically, if you want to just find a better version of the general realized profit and loss, I really am interested in the long-term holders. See, when the long-term holder who held through the crash to 74, 73,000, 74, I think it was the low, when they start to spend, they have not even start to spend large enough amount to reach to the half a standard deviation. So far, throughout the recovery from 74 to 109 or 106 when this chart was created, we have not reached to half a standard deviation above the norm for long-term holders. So they stayed quiet, and that is a positive thing, because they could have very well used this opportunity and start to cash out, but they have not. When they start to cash out at one standard deviation, and if you zoom in, it happens really fast. It's a matter of 1 week or 2 weeks after they see the opportunity good enough and start to spend. We have not seen that. So to our readers, I really recommend, and we will update everyone every week by this chart. When the long-term holder see the opportunity, probably when we are way above, stabilize above 110, when we see them starting to spend at statistically significant level, that's when we can speculate about, hey, this is probably top formation. The demand side is probably getting exhausted. But so far, we are in a very good position. And I hope actually we get to see another new all-time high, because I believe replicating the 2016 cycle is another confirmation that the 4-year cycle is probably not a valid hypothesis for future. To wrap it up, I just want to show one metric that is a little bit complicated, but is going to help to, when used alongside the long-term holder profit taking. When we use these two charts, we're going to be super well positioned to spot the possible top in the market, and that's the AVIV gradient oscillator. I just want to simply explain what it is. AVIV, or true market mean, is this orange line. This is measuring the cost basis of the investors, and we are discounting the miners or whoever earned coins from the mining. We are talking about the investors who purchased Bitcoin in the secondary market. That's why we are discounting Satoshi coins, and we're looking at the active investors mostly. If you look at the cost basis, is around 67. And when this price is going up, that means actual money is coming, and if capital is being deployed to the market. And when it's going down or going sideways, that means on a net basis, not enough money coming into the market. And when this is going up, you could see the price or market cap reacts to it by going up, sometimes faster, sometimes at the same pace. The charts here you can see at the bottom, let me turn off most of them, is measuring the difference between how fast the market cap going up and how fast money is coming to the market. So there is a deviation between these two. For every dollar coming to the Bitcoin market, probably 3 to 8 or sometimes $20 increase in market cap is expected, depend where we are in the market. When this metrics is really high, that means when we are seeing $1 coming in and market cap goes up by, I don't know, $5, $6, $8. In that situation, we're saying people are FOMOing. They're pricing Bitcoin way higher than it's supposed to be. And that's a very nice metric to spot the potential tops in the market. When we look at the 30-day, looking at the last 30 days capital inflow to the market versus the last 30 days increase in the market cap, you could see we are probably at the risk level equal to what we saw in November 2024. And if we stabilize above 110, we have to look at the longer term of this metric, which is the 90 days one. That one is not risky yet. We have not reached the level we saw before. So if I want to wrap up on-chain part is looking at the short-term movement. It was a very fast movement. Long-term holders stayed away. They didn't spend much. The perpetual is lagging a little bit, but the spot market is so strong that reaching to 110, like we said last week, was very well expected. But if we want to talk about 150 or 120, we need probably a little bit of stabilization. And if we had a correction, as far as we are above the 94,000, which is the cost basis of short-term holder, we shouldn't be concerned. But if, for any reason, if we see a correction below the cost basis of the short-term holder, which is 94, we have to check it every day because it's a dynamic concept. It might go up a little bit. If we stabilize below 94, we can say we replicated literally the second top in 2021, and we had a rally to the previous all-time high, almost 5 plus minus 5% previous all-time high, and market start to see a lot of profit taking, and it couldn't manage to break above that. That's why I would have named that piece now or never. Right now, we should hope for macro just stay positive, or at least we shouldn't see any big negative factor, and stabilize above 110. Then we can talk about 120 or 125, or I don't know, maybe 150. All metrics should be really monitored closely, especially the profit taking by long-term holder and the market gradient, which I explained just now.
Yeah, and what really makes this interesting is we have a clashing of different forces. We have a short-term shock that the economy will experience from all that trade war. And then there is issues with the bond market and the loss of trust and confidence in the U.S. treasuries, and sometimes even the U.S. assets overall. But the effect of that, it might be bad for the tech sector or the stock market overall, but the effect of that on Bitcoin and other hard assets is probably going to be very complex and interesting. Let's say you are a Chinese investor, you dump U.S. treasuries, right? That can cause cascading effects, also crashing the stock market. But at the same time, you move that money back to China, repatriate your investment, and some of that money actually finds itself in gold and Bitcoin, and of course the Chinese stocks or some other local assets. So the idea that some investors are dumping the U.S. assets, it might actually not be as bad for Bitcoin than regular assets. And in fact, Bitcoin has this other second side. The first side everyone knows is risk. It's correlated with NASDAQ and all that. But it has a second side, which is a hedge against chaos. And, as the confidence in the existing world order goes down, we should see a bid to gold and to Bitcoin. So, and we are seeing that, like we do have a deteriorating macro, at least weak macro regime, but Bitcoin is reaching the all-time high. That to me is a very interesting phenomenon, very interesting, very telling. And sometimes, like the day after Moody's downgrade, Bitcoin was up. And it does go down when the stock market goes down, but goes down less, and then on the way up goes up more. So this shows that on the balance net capital is in a war between countries, but then Bitcoin is absorbing, chipping away at that and absorbing little by little some of that capital. So seems very interesting so far. We'll be watching the data to get a better sense of where things are going, and definitely stay with us if you like our analysis, and watch what we have to offer at 21stcapital.com/BI. Any other final points, Z?
No, like I said, hope we see the macro just hold on a little bit. I really like to see 118, but like I said, the profit taking is what's going to determine how sustainable this rally is going to be, and those two metrics at the end are going to be really interesting. And I think we will update everyone in next report, specifically on two metrics that was concerning the realized profit by long-term holder and market in general.
Fantastic. Yes. Yeah, we will be updating everyone about the on-chain flows in the next newsletter. Be on the lookout for that. 1900 views, and we are 37 minutes in. I think we had a really dense session today, and we are looking to make it even denser. So we don't want to really add to the duration. I think this is a good place to pause. What do you think?
Perfect. Yeah.
All right, fantastic. See you guys next week.